Hello and welcome to Wholesale Change, the webcast and podcast from Distribution Strategy Group, where we provide thought leadership for wholesale change agents. And if you're on this call, you are very probably a wholesale change agent. My name is Ian Heller. I'd like to welcome my business partner, the Tower of Analytical Power, the Doctor of Distribution, Jonathan Bine, PhD. How you doing today, Jonathan?
I'm doing great, but I'm wondering what it's like to be an Ian.
It's a combination of nightmare and delight.
You got the whole spectrum.
I'm not on the spectrum. Well, maybe a little.
I said the whole spectrum. I didn't say you're on the spectrum.
Not the spectrum. Right. Well, we have a very interesting topic today. It's why your best accounts have the most potential. And we have mixed feelings about this, right? I mean, well, you start.
Well, I think there's different, I think we have to look at what we mean by best. And that's really the key thing. Actually, in my first distribution consulting engagement with Ian, 11 years ago now, Ian?
Yeah, more than that.
2009? Yeah. Blame it on Ian. We were working with a company that had two segments. Both were very large.
Mm-hmm.
One of them was growing. One of them was shrinking. One of them was really profitable. One was really not profitable. And so what we saw was that we have to look beyond sort of point in time perspective on what constitutes a good segment and or a good account.
Right.
And I think that was the really big insight that's put us on the path to thinking about analytics and best customers in a different way. Back to you.
Yeah, no, I think, what I was thinking about was that I think generally speaking, if you want to get sales in the short term, if you need to get more sales, then big customers are the place to go, right? I mean, they know you're the best. And look, it's an old saw, right? That an account manager, in order to make plan, calls his best customer at the end of the quarter and says, hey, can you do me a solid and place an order now that you were going to place till next month, right? I mean, that's not real incremental business, but that's the kind of relationship that distributors often have with their best customers, where they can ask for favors. And also, I think you're almost always less penetrated in it looks like you've got
Looks like I'm in a disco. What's happening is you got wind outside, and I'm getting different shadows. So I'm just gonna...
Nice shorts.
Yeah, thanks.
So I think, with big customers, you have the opportunity to get more, and you're usually much less penetrated than you think, right? For the most part, you're not getting nearly the wallet share out of a big customer that you think you are. And so there's typically room to go back and get more. And I've seen inside salespeople team up with outside salespeople, and the inside salesperson actually works on identifying more contacts at a big company. And so they ask their contacts, hey, is there anybody else we should be talking to there? And they just make a list and they hand it off to the account manager, and they go and and sign up more buyers. But anyway, so let's go to the first slide and start the dialogue. All right, so there's some reasons that big customers are more profitable despite the fact that they have lower gross margin. And you actually mentioned this one this morning, Jonathan, when we were doing our pre-call. Which is that they're more likely to have people who are professionals at procurement, right?
Yeah, and there's a couple of things that follow from that, right? In terms of efficiency, in terms of how they think about the cost of procurement, theirs, which is benefit to you as well. So,
yeah, I mean, they know what they're doing, right? So they're trying to reduce the same procurement costs that you're trying to reduce, right? I mean, so if you've got a customer and they're coming in 3 times a day to pick up items, there's an opportunity there, and they see it too, because they're big enough to be sophisticated and understand that every additional PO costs them money. Every time their runner makes a trip to your counter to pick up supplies costs them money. And that's no more efficient for them than it is for you. And they actually are sensitive to those costs, whereas small customers tend to view those costs as, sort of not meaningful.
Yeah, and I've heard commonly, and I've seen a study done, commonly a three-digit cost for them to do an order. And it's like
Mm,
it's $100 or more for them to do an order. So,
right.
right?
So,
We tend to think about our costs as distributors in terms of doing an order, but they have a cost as well.
absolutely. And Eric, a good friend of the show, has just written into chat, and he says the wallet share issue is important because sellers without data often think they are getting everything. Usually, sales are escaping to other distributors 2, 3, and 4. And I think, yeah, that's exactly right. So, uh, I can't tell you the number of times I've been with an account manager and I've asked, what percentage of this account's business are we getting? And he or she will answer, 100%. I'm like, really? 100? Well, maybe 95. And once you do the analytics, they're not getting anywhere close to that. Then they may think they are. They may be getting close to that from their own contacts, but it's very, very unusual to be getting that kind of wallet share. And I think Eric's exactly right that you really need to understand what the wallet share is and, put actions in place to get more of it because you're not getting as much as you think. Second step is they on average place larger orders. If any of you have worked with Waypoint Analytics or Profit Isle, there's a lot of thinking in distribution about how larger orders are inherently more profitable because there's a relatively fixed amount of service costs. So, to pick, pack, and ship a bigger order, sure, it costs more than it does to pick, pack, and ship a smaller order, but it's not linear, right? So you've got more efficiencies. And that means that even though the gross margin may be lower, your costs are proportionally even lower than that. And so on average, they place larger orders. Have you seen this is there a correlation in your experience between account size and average order size, Jonathan?
Absolutely.
Yeah,
And
me too.
we'll take a look at some data here in a little bit that is really going to bear that out. But um, there's really very strong correlation, very strong R squared, if you want to go all statistical on it in terms of order size and customer size.
Let's go R squared, but I regress. Sorry, statistical joke. So they're more efficient to do business with, I think, because they tend to, in my experience, they have fewer returns as a percentage of their business because they have professionals specifying and buying products. They're less likely to make mistakes, right? Oh, oops, I ordered the wrong thing, or, they don't lose stuff. I mean, they tend to be tighter run ships just because they have specialists doing individual tasks. Now, don't get me wrong, there are small companies that are extraordinarily well run. But we're speaking of the averages here. And I think we already mentioned that they're sensitive to procurement costs, but they actually have measurements in place. I mean, I remember when I was at Grainger, we said, the average PO costs you $150 to process or something like that. The big companies really took that to heart. I mean, they got that if they could, process fewer POs, they would spend less money on procurement. And that's really a lot of what drove the movement towards EDI and e-procurement, et cetera, because it was an opportunity to take cost out. And how about this next one, Jonathan? They need you as much as you need them.
Well, yeah, I mean, from a sales standpoint, we always think that, that we need them more, but they have to get something done,
Yeah.
right? And they know they have to get something done. And so I think that's kind of at the heart of this. What else are you thinking in this particular point?
What I've seen is as customers get big with a distributor, the exit costs for the customer go up dramatically because you build dependencies. So the distributor's in there all the time. They may do anything from services like, kitting and labeling or whatever to panel building, or they could also be, we might have ordered custom inventory for them. And those customers become somewhat dependent on you. I mean, the smooth running operation of their business depends on the distributor providing a steady stream of supply and services. And here's a real world example. This was a long time ago, but I think it's still true. When I was at Grainger, we had a bunch of national accounts and they had negotiated some very low prices. And at some point in time, I don't know if it was the CEO or the CFO, they said, look, we can't make money with these accounts at this gross margin. And so we tried to fire 70 or 80 of them. Right. And, we tried to negotiate with them. look, we need higher prices. We just can't make a living on what you're paying us. No, 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 no. So finally we threw up our hands and we tried to fire 70 or 80 of them. Like 90% of them came back and said, wait. We didn't know it was that bad. We'll work with you. And we fixed the gross margin problem, because the reality is there were very high switching costs for them. And it introduced business risk into their operations to switch suppliers. And so, I think distributors sometimes have more leverage than they think anyway in pricing, but they certainly have some leverage with very, very large customers, because those customers are dependent on you. And so that gives you some room to move with them in terms of, making the business relationship efficient for you.
Yeah, we saw another case like that with a company. This was in the building material space as well.
Mm-hmm.
Tried to fire a bunch of customers by raising prices. And what we noticed was at about almost exactly 12 months later, 75% of those customers came back around, because what they
Wow.
realized was there was actually really high value in what this distributor was doing for them in the building material space.
Huh.
Um,
Well, this was MRO in my case. It was at
okay.
Grainger. Yeah.
Okay.
But I think it's true. It's probably more true in building materials, even at least specific to a job site, because it's like there's already a risk. Construction sites are so prone to risk because you've got weather considerations and you've got dependencies from between subcontractors and from the sub to the general. You've got potential financial risk because a lot of these contractors, the smaller ones anyway, they don't have a lot of wiggle room in their working capital, and then and then you get the supply dependencies, and there's to replace a supplier in the middle of a project introduces a whole new level of risk. So I think you can work with the customer to help you lower the soft costs, even if they don't want to pay you more money.
Well, and I think that was also part of the thing, the soft costs related to the value that these guys were able to deliver, not just to the job site, but to the floor, to the corner of the floor in the building. I mean, they were able to get very specific. Their customers decided, hey, it's worth another nickel or dime to get that value, even though they're asking me to pay higher prices on the products themselves. So,
right. But there's clearly a correlation between size and gross margin, right? I mean, it's pretty, to use a statistical term, that's a pretty reasonable R-square, isn't it?
Very reasonable.
Yeah.
If you think about the gross margin of your entire company, it's pretty close to the gross margin of the top 10% of your customers, because they form such a large percent of your total revenues. So if you're 38% gross margin for the entire company, your top decile is probably 37.5% or something like that.
Yeah.
It tends to dominate the numbers.
Yeah. And you're a high margin company.
And you're a high margin company. Right. Yeah. Those are
All right. You want to go to the next slide?
You bet.
And so for our radio listeners, for those of you on podcast, this is called a market demand analysis. And so, Jonathan, you want to describe what we're looking at here?
Yeah. There's a couple ways to think about the different parts of what you can sell and who you can sell it to. So the largest universe is what we're going to call the total available market, meaning everything that the customers are buying. You may not be capturing a large portion of that total available because it's such a big number. So based on what you're selling, the total available for this account is $1 million, but you're only getting $100,000 of that, right? The total addressable is what you're likely to get. So based on how you sell, how you go to market, products you have, locations you have, how well you sell, the total addressable is what you're likely to get in an account, right? So again, in that example, the total available for that account was $1 million. The addressable for you was 200,000, and you're actually getting 100,000. So you've got another 100,000 of addressable you could get, and another 900,000 of available that you could get.
And which one's wallet share?
Wallet share, you could have wallet share of addressable or wallet share of available. So it could go either way. But the reason that it's useful to think about available versus addressable is that one is a more strategic number, and the other is a more tactical number. When you look at the addressable number, and we do this analysis for customers routinely, we can say, here's what you're likely to get in this segment for this particular customer, for this particular product. That's a more realistic goal for you to achieve. When you start to look at the total available number, and when you start aggregating and adding all those numbers up across your customer base, you could start to make some strategic decisions. You might decide, hey, look, there's a really big available market in fasteners, and we don't currently sell fasteners much. Maybe we want to be selling more into the fastener segment because there's such an opportunity there. Or if we look at it from a segment standpoint, we're not selling much to HVAC contractors. We're selling more to general contractors. There's a lot of available market that we could be capturing in the HVAC contractor space. So you might want to use that to make strategic decisions.
That's exact. If I could interject, that's exactly right. I mean, what I've seen this used for, I think, in a strategic sense is, trying to decide what's the market potential of the firm based on our capabilities today, which often includes a geographic component. We're not in these markets. So my last company, we didn't really have any operations in Detroit. So Detroit was not, that was part of the available, but not part of the addressable. Fair enough.
Absolutely. Yeah.
Right. Or we didn't carry a line of goods. We didn't offer a certain service and so I think, having this number is really important because when you go through your strategic planning, the capital investments you're going to make and the strategic initiatives that you're going to implement are often around expanding the addressable into more of the available market. Right. And but here's the connection to big customers. And by experience, a lot of times big customers are the horses you ride, and I'm going to call your customers horses. They're the ponies you ride, that's better, to charge in to this available market. So for example, let's say that you're an MRO distributor and you don't have operations in Detroit, but you sell to, I'll make up a name, ITW plants in the Chicago area. Well, a lot of times you can work with that customer. You can go to ITW and a dozen other customers and say, hey, we're thinking about opening up operations in Detroit. If we did, could we get your business? And this is where big customers can be very strategic and helpful because they can help you understand in advance what kind of revenues you might get as you expand your capabilities and expand the market potential of the firm out of the addressable and more into the available. Does that make sense?
100%. Spot on. Yeah. Well, and the other thing is if you're looking at available market and you show an available number to a sales rep, you're just going to get an eye roll. They're just going to say there's no way there's that much potential or opportunity in the account that we're talking about, right?
Right.
So you really have to use them both, the available and the addressable. Now the sweet spot, we're going to talk about the definition of sweet spot, but the sweet spot are there really good segments for you, really good customers within your total addressable market. So if for our radio listeners, the sweet spot is a subset of the total addressable market. The total addressable market is a subset of the total available market. Just as a comment, by the way, the total available market could be 5, 10, or 20 times your addressable market, right? We see those kind of ratios frequently. And again, because the numbers for the available market can be so large, when you show a number of available about a specific account to a sales rep, that's why you're going to get the eye roll, because it just doesn't correspond to anything that they think they could ever possibly sell.
So are the factors that define available, addressable, and sweet spot unique to every company?
The factors that define available are more a function of national demand. In fact, I would say that they are independent of the company.
Okay.
It's really what's happening at a national level from demand. But the addressable, when we do addressable, we're looking at where you sell well and where you don't sell well. So if we're projecting onto a set of prospects based on your current customer base, and you don't really sell well into a certain segment, it's going to reflect that in our estimate of the potential in those prospects. By contrast, if you're crushing it with a certain segment, those prospects we're going to predict that you're going to have a lot of potential there. So.
And Eric has contributed another comment. Thank you very much, Eric. We encourage others to do the same. So he says, love the sweet spot. Think about your best customers, the ones you are growing, the ones that are profitable, and let that help you define your prospecting targets. So so that's like a lookalike analysis, right?
Yeah, it's an ideal customer profile, right? You do an ideal customer profile, and then you say, let's take the best segments. And Eric, thank you. This is like a perfect lead into the next topic that we want to discuss, which is how do we think about what a sweet spot is, right? How do we define a sweet spot? As we mentioned at the outset of the call, it's easy to think about, well, we did this much volume in this segment or this account last year, and that's a point in time kind of number. But there's a lot richer ways to think about a sweet spot. In an ideal world, we're able to think about operating profit or net profit of the customer, not just gross profit. By the way, we're going to have Randy McLean from Waypoint on in a couple weeks, and he's got a lot to say about how to think about operating profit, or what he calls net before compensation profit, as a way to really get below the gross profit line. So when we look at defining a sweet spot, we look at 4 dimensions. We look at the growth in your customer base. So what is the compounded growth? And you could take revenue, you could take gross margin, operating margin, you could even take the number of accounts. But we often will just look at the growth in revenue because that's an easy thing to understand. When we look at profit, again, we have a number of choices. We could look at gross margin percentage. We could look at operating margin if that's available. But in the absence of having operating margin at the account level, very few companies, very few distributors are able to measure that reliably. We have found that the gross profit dollars, the average gross profit dollars in an order, is a pretty good proxy for profitability. And I
So
think
it doesn't address service costs, but you really need a tool like Waypoint or Profile or somebody like that to do that, right?
You do. Yeah, I mean, if you want to understand the cost to serve, and therefore the operating margin, you need a Profile or a Waypoint to do that. But in the absence of that, using gross profit dollars per order is a pretty good proxy.
So it's
and
better
we've
than
actually done
nothing.
some statistical analysis on that.
Yeah.
When we have operating margin,
Yeah.
and we've run regression to see how that works, and gross profit per dollars is a pretty decent proxy for that.
So my guess is Randy McLean will dispute that when we talk to him. And
Oh, no doubt. I mean,
yeah.
Randy will get out the gloves. In fact, he might even take off the gloves on that one.
Yeah. And so I think, look, we're open to other ideas on this, right? I mean, like, the notion of activity-based costing has been around for a while.
Mm-hmm.
And I think, the benefit, and we don't have any financial relationship with Waypoint. So we're not, there's no bias to this recommendation, but I think the notion that you need to quantify and apply on a regular basis an operating cost model or cost to serve model to your gross profit dollars per order, that's a pretty smart thing to do. I mean, I think there are different ways you can apply that information, get benefits out of it, but it does give you account level profitability and line level and business unit level down to the branch or the account manager. And it's very powerful stuff, right? Now, Derek, another friend of the show, has also made a comment. This is a powerful exercise to conduct as an organization. So Derek's talking about the addressable versus the available market. This is a powerful exercise to conduct as an organization, really trying to understand the addressable market and what your fair share could be. And that's exactly, I think it's powerful because it tells you how you're doing. It's also powerful because, like I said, it's a great feed into strategic initiatives that expand your capabilities, whether that's new branches or product lines or services or more account managers or whatever. I mean, I got to tell you, for many distributors, so this correlates to the fact that your big customers are often the most profitable and your big customers are often the most, efficient, right? There are many occasions, I've seen this over and over again, where by far the best way to grow the business is to do better with big customers, which means doing better with your sales force. And the whole notion of adding more salespeople, enhancing account productivity, putting in superior sales management tactics, I've seen extraordinary results from just focusing on that. I want to make sure that I have the best salespeople possible. I train the heck out of them. They're making calls every day, during business hours. They're highly productive. I'm coaching them. I got to tell you, all other strategic initiatives aside, there are a lot of distributors where if they just did that, they would get vastly better results because sales reps are aimed at these big customers, and they're going to go and land more of them and make them more efficient. You're going to get those gains that are inherent to operating with large customers. And, I come out of a marketing background, but I've seen some extraordinary results from really aggressive and effective Salesforce management.
Yeah, it's a hard ship to turn around, but the results are definitely worth it, right? If you can do it.
It can be done. It can be done. And it manifests itself in these big customers that we're talking about. So anyway, keep going. Sorry.
So no, this is all good. So, another dimension is the potential or opportunity. So, the opportunity is what we say is what's left. So if you're selling them $20,000 of stuff a year, and the potential says there's 30,000, then 10,000 is what's left that you can go sell them. It's kind of the remaining opportunity. So sometimes we do addressable and available. Oftentimes, if we don't have access to the available, we'll just do the addressable. And as Ian's saying, that's a powerful exercise. And then finally looking at sales volume. So there's a little bit of what do you want? Do you want growth? Do you want profit? Do you want opportunity? Do you want volume? Do you want some combination? And what you'll often see is that segments have different combinations. They might be great on potential or opportunity and on growth, but not on profit and volume, or vice versa. Let's take a look.
Well, hold on real quick. Let me just summarize for podcast listeners. So
Please.
The sweet spot definition is growth, profit, potential, and volume. Yeah. And so, it's finding customers that really maximize the four of those collectively is your sweet spot, right?
Absolutely. Yep.
Okay, go ahead.
Yeah, thanks for that summary. Yeah, and again, you won't find a segment, or you rarely find a segment that's highest growth, highest profit, highest opportunity, highest volume. It just usually you're going to see a trade-off along one of those dimensions.
Right.
So let's look at a really simple decile analysis. This is representative of customers that we work with. Gross margins might be a little bit higher. We've kind of mocked it up here to protect the innocent. And so what we're looking at is about 10,000 customers, and each decile has 836 customers in it. So the top decile's got the largest customers, the second decile's got the second largest set of customers, and as you go down, you get to smaller and smaller customers. There's a couple of interesting things here to point out. So the first is that as we look at this first decile, it's got 388 million of revenue in it, and it's the lowest gross margin, so it's a 36% gross margin, but it's the highest gross profit per order, average gross profit per order, $630 of gross profit per order. So if you think about, an order that costs $100, maybe even $150 to send nothing, these guys have got another average $480 of gross profit in those orders.
All right, so I want to jump in here because I don't think most distributors look at it this way, and I think this is the right way to look at it. So the distributors, in my experience, and by the way, I've been around the block, but not around every block, and my experience is that distributors tend to look at total sales of a customer and gross margin, and that's it. So average order value is not a part of the analysis.
Yeah, and the problem with gross margin is that the variability in cost of goods is far less than the variability in cost to serve.
Right.
Cost to serve is what happens between the gross margin line and the operating margin line.
Right. And so they're not looking at average gross profit per order is what I meant to say. So they might look at average order size, but they're not looking at average gross profit per order. And the intuition behind these cost to serve companies like Waypoint is that is a huge driver of bottom line profitability because service costs are so variable or so correlated to gross profit per order.
That's right.
So let me ask you this. So if I'm looking for average gross profit per order, the variables are what's the average order size, what's the gross margin of the order, right? And then I multiply one by the other and I get average gross profit per order.
Correct.
Okay. So the notion is that it's much cheaper for me to process fewer larger orders than more smaller orders.
Correct.
That's the whole intuition behind Waypoint, right?
That's the whole intuition behind Waypoint and cost to serve analytics and metrics.
Got it. Okay.
And if you look at every dollar of gross profit in the order above the cost of the order,
right.
that's where the fun starts, right? So this $630 average gross profit per order is way more profitable. It's way more than 2.5 times more profitable than the $250 gross profit per order.
Right, because my service costs are lower.
That's right.
As a percentage.
That's right.
And so I don't think, the distributors that you've talked to, unless they've been exposed to one of these cost to serve companies, how many of them are looking at it this way?
Well, I guess it's before or after we get involved.
Right.
Before we get involved, I don't know that I've seen anybody who is.
Okay.
They're either using Waypoint or Profit Aisles, or they're not thinking about profitability in this way.
Got it.
And what you see here for our radio listeners is that in the top decile, it's $630 gross profit per order. The bottom decile is $43 gross profit per order. They are certainly losing money on customers in that decile. The ninth decile is $78 gross profit per order, certainly losing money on customers in that decile. You can find it anytime you do this analysis, once you understand your cost per order, you can see the decile below which you're losing money, right? So if their cost per order is $150, they're losing money in deciles 8, 9, and 10. Fortunately, deciles 8, 9, and 10 are not high volume. But if you look in the contractor world, you'll often find that your smallest contractors, 1 to 10 employees, are giving you a $75 gross profit per order. You're almost certainly losing money on a large swath of your customers because they're giving you small orders. So a couple of other things here that are notable. So one is, we mentioned that this top decile's highest gross profit per order. It's also the highest opportunity. Tying back to the title of the talk, there's another $120 million of potential in this account that hasn't been tapped. And that was what Ian was saying, that going to your biggest customers is going to be the way you might meet this quarter's numbers. But even beyond this quarter, really dissecting that, looking at how that breaks down in terms of different product categories. You're selling in product category A, but you don't have a ton of product category B, and you should. So that's where you take the sharper pencil and you go back and you really sell.
So that number in this particular case is about the same as the rest of the decile opportunities combined. So
correct.
Your top 10% of customers have as much additional opportunity as the other 90% of your customers combined. So it's a 90-10 rule.
However, cautionary note here, often there is as much or more potential in the smaller deciles.
Okay.
The lower deciles. And
so that's just unique to this particular example.
It's a little bit unique, yeah. Okay. But what I would say is that, like a lot of times, you've got untapped potential. The biggest company, Exxon, just bought the smallest product, AA batteries, from you.
Right.
Well, Exxon has certainly got much more potential than buying 5 packs of AA batteries.
Sure.
So there are acorns that could become oaks often in these smaller deciles, and it's worth really understanding the potential, and then applying some wood behind the arrow to grow those accounts.
Got it.
The other thing that you'll notice, again, that this top decile is the lowest gross margin percentage, but it's the highest gross profit per order. And the opposite, the decile 10 is the highest gross margin. It's like 47% gross margins. Who doesn't want that? But it's the lowest gross profit per order. So again, when we step back to the 4 dimensions of what we want in a sweet spot, we want volume, we want potential, We want some measure of profit, and we want some measure of growth. And it's important, if we're looking at profit, not to just look at the gross margin percentage. Other thoughts from you, Ian?
No, I mean, I think this is, I think it's coming from a long marketing background in distribution, I think, in many organizations, there's some hostility between marketing and sales. How I feel about that. If that's the case, it's marketing's job to make that work because, when sales and marketing disagree in a distribution company, sales always wins, whether or not they're right. And so you're going to have to win them over if you're in marketing. Part of what you need to do is win over the sales force and get their support, because you're not going to get anything done if you can't. So, people get caught in these arguments about fairness and justice. I'm like, look, the real world's the real world. Win over the sales force. That's your job. If you can't do it, you can't be an effective marketer, period. Okay. And so what tends to happen is with marketers, they get this jaundiced view of the sales function, and they start attacking the most successful salespeople and the most successful in the largest accounts, because they want to point out that, well, yeah, but look at the gross margins and look at the cost of service, et cetera. And as a salesperson, that's frustrating because you work your butt off to go and land this business and grow it. And then some person from corporate is coming in and attacking you. And I've seen that over and over again, by the way. That's not an isolated case. And I would say you need to take a different tack. If you're in marketing, you need to help these salespeople expand their wallet share in these big customers, whether that's selling tools or capabilities or data that you provide them or whatever. Be an advocate for the salespeople, be an advocate for going out and getting more wallet share for big customers, and give them tools for how to do that, and go make sales calls. Let's help the salespeople succeed. And, so I think you need to understand that big customers are not the enemy, and salespeople are not the enemy, and marketing applies equally across all customers in terms of its need. It's not, because that's another mistake that I see companies make, is sales is the big customers, marketing as the small customers. But whenever you administer marketing campaigns against all customers, the big ones always buy the most.
Right.
Even if you're not advertising their prices, because they know that they get discounts. So like I've done a lot of direct mail and email campaigns against big customers, and we're advertising prices that are higher than what they pay, but they know that because they know they have a special deal. But the point is, they understand now that there's a promotion or there's something else going on, and they react to it. And so marketing needs to take responsibility for marketing to the entire customer base, including the largest customers. And I just think that battle needs to be over, because it's not productive. It doesn't help anybody.
Coming back to our big customers, lower margin, but more profit. I think there's what we've seen is there's often a couple of exceptions in a customer base. And let's just talk about this for a second, Ian. So this might be a customer literally whose gross margin is single digit.
Okay, right. Well, there's a limit, right?
There's a limit. And, I've looked at billions and billions and billions of dollars of customer transaction data and doing customer profiles, in creating these sweet spots, doing demand estimation. It seems like there's always one or two of these power buyers in a customer base. You made this comment about, marketing is coming back and criticizing these, the work that they're doing, the accounts that they've chosen. What is your understanding of, or how do you think about these power buyers that might be single digit percentage or very low double digit at the highest?
Well, I also mentioned that I've been part of a team that's tried to fire customers because they are at an unacceptably low level of profitability. I mean, I don't think you should run your operations at a loss, right? And that's what, I mean, there are going to be money losing transactions. There just are. And if you try to take steps to eliminate all money losing transactions, you'll do more harm than good. But you want to get them down to a manageable level. And if you have a rogue customer who's just saying, look, I will not pay you a living wage, I will not pay you a margin you can live with, then you should consider firing that customer, right? Because the effort at some point in time, that's not a relationship seeking customer. I mean, they're not looking to optimize the business relationship. They're looking to screw you. And I don't want to do business with people who are trying to, cheat me out of a fair dollar. And so, I think most of the time, but the number of times when I've seen it come to that, I can count on one hand, right? I mean, you just, every now and then you run into someone who's just irrational and reasonable, and they view all these situations as win-lose. I win, you lose. But it's really rare. I mean, most people are pretty rational about how they run their businesses. And
I think the argument from the distributor in that case would be, well, these guys help us keep the lights on. Look at the volume they deliver, right? That's going to be the rejoinder.
Look, I mean, that's not an entirely empty argument, because sometimes you're hitting rebates, because I mean, let's face it, a lot of times the system or ticket margin is a lot different than the fully loaded margin, right? So you're getting, rebates and co-op and et cetera from companies on the back end. So I think you have to take that into account. So, it might be that I've got a customer and they're, unacceptably low margin, but they're buying $1 million in lamps, and that puts me over my threshold with my lamp supplier. And so the rebate makes it worthwhile. So I think you have to take it on a case by case basis, but generally speaking, I try not to have customers who are structurally unprofitable in the long term, even if they're big. I don't know. What do you think?
I think that's right. Well, I think the other thing is, if we look at, again, at the gross profit, operating profit, or cost of goods, cost to serve, you better make damn sure that their cost to serve is really in line if their margins are super, super low.
That's exactly right. Yeah, you can't be speculating.
Right. Yeah. So, final thoughts before we conclude our show from today.
Yeah, a couple things. One is, we're always available for a phone call if you want to talk. If you want to do an hour on the phone, we don't charge you for friendly dialogue, and we learn as much from those conversations as you do, I'd like to think. So please give us a call. We're not, as you can probably tell by the tone of the show, we're not the hard sell types, but there's certainly distributors that we can help. And if you think that you may be one of them, please let us know. And then last, we're doing a big project with the National Association of Wholesalers. It's a series called How Technology Will Transform Wholesale Distribution. We had our first webinar yesterday. It was really exciting. It was very well attended. I encourage you to go to naw.org and look it up. The first one was called The Coming Storm of Converging Technologies. We talked about how artificial intelligence and marketplaces are transforming wholesale distribution. If you go to naw.org right now, this series is in the top rotating banner when you get there. So we encourage you to download the report, and we encourage you to watch the webinar. And as always, please keep in touch. And thank you so much for attending the show. We appreciate it like you cannot imagine. Jonathan, as always, great to work with you today, my friend. Enjoyed it as usual.
Feeling is massively mutual.
All right, my friend. Have a great day. And thanks everyone for attending.